Hello, and welcome to the February 2022 Economic and Market Update from Commonwealth Financial Network. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. After a strong close to 2021, markets pulled back sharply at the start of the new year. Markets were down across the board, with the U.S. indices dropping between 3 and 10%, and while international markets did slightly better, they were still down. Even fixed income assets got caught up in the storm, largely on interest rate concerns, as broad indices dropped between 2 and 4%. It wasn't just one thing either, as the bad news kept coming during the month. The Omicron wave was certainly a big part of it, because as case growth rose to new highs, well above any of the prior waves, both consumer and business confidence took a hit, and showed signs that spending and investment might decline as well. Beyond the medical risks and the associated economic damage, though, there were also other concerns. January reports showed inflation at a 40-year high, shaking confidence further. And with inflation now a greater worry than employment, the Federal Reserve announced that a rate hike in March was very likely. In many ways, January was a perfect storm of bad news, both for the economy and the markets, and the poor performance we saw was no surprise given that. And yet, despite all the bad news and the market pullback, there were positive signs as well. For the medical news, COVID case growth was down by over 40% from the peak by the end of the month, and there were similar but smaller improvements in positive test rates and hospitalizations. The Omicron wave looks to have peaked, and that'll limit its effect on future growth. So while we'll certainly see more signs of economic damage through the February reports, it should fade into the spring. Similarly, while inflation is at a 40-year high, there were signs that it may be peaking as well, which may limit what the Fed actually does, as compared to what the markets now fear they might do. And that showed up in interest rate markets as well, as rates seemed to stabilize at month end, up from the end of the year, but still below pre-pandemic levels. Now, the key question going forward is whether the economy has enough momentum to keep growing through the current medical and policy worries. So far, the answer looks to be yes. The country remains open, and job and spending growth has stayed reasonably healthy despite the Omicron wave and all the other troubles. So while we've seen some economic damage, and we'll likely see more over the next month or so, things have largely stopped getting worse and started getting better. And the same applies to the markets. While there are real risks and concerns, the fundamentals of corporate earnings still look very healthy. And as long as companies are making more money, the stock market has a cushion beneath it. And even as valuations adjust to higher interest rates, there are signs that rates will remain at or below pre-pandemic levels, which will also provide a cushion going forward. Now, that's not to say we're out of the woods, of course. COVID could make a comeback. Inflation could persist longer than now looks likely. We'll likely see more volatility as more risks surface, and there are more risks out there. But as we move on from a difficult January, the bottom line is, despite the risks, the Omicron wave, inflation, the Fed, and others, the economy is still growing, and the fundamentals for markets still remain strong. While we've seen substantial volatility, and we may see more, that provides a good foundation going forward. That's it for this update. Thanks for watching. Join me in March for the next one, but until then, be sure to check my daily blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.